If you're doing all right, maybe you give me 1. You type 1 in the chat box to let me know that, yeah, you are doing all right in this year and you're doing awesome. Yeah, Azizon said red market, right? Chinese New Year comes early this year to the stock market. Okay, everything is very red. Oh, okay. So many of you are still doing all right, despite the red market. Red ocean. Yeah, unfortunately. So because as value investor, we like red market, because then only we got chance to go in cheap. Okay. And I also had a decent start of the year. I just contracted COVID like a couple of weeks ago. And now I'm still recovering. Okay. I still have some dry cough occasionally. So if I needed to take a break during the webinar, please excuse me for a bit. Yeah. And my throat is still little bit dry. Okay. What is Chinese New Year ang pao stock? Wow, this is interesting question. I can't give any recommendation to stocks, so better stay away for this kind of stock recommendation question. All right. So before I begin, I just want to check if you're speaking to the right group of people. So raise your hand if you're here because you want to learn how to make money from the stock market. All right, you can click the raise the hand button. Okay, thank you so much. Yeah, you may now put down your hands. So another question. Okay, somebody loves to make money, but how about this? Okay, raise your hand if you're here because you want to learn how to make consistent return from the stock market year in and year out. Okay, please raise your hand again if you want to learn how to make consistent return from the stock market. Okay. All right. Thank you so much for all the hands that are raised right now. You may put down your hands. Thank you so much for participating. I try to make this session as interactive as I can, and so that I don't feel that I'm speaking to the computer myself. So if you can give me some response when I ask you a question, that will be great because that will give me more energy. If I have more energy, then I'll share more with you. All right. So this is exactly what we're going to do today. Today we're going to talk about how do we make 10 to 30% return in the stock market every single year without the risk of losing your hard-earned money, even if you have no financial background. So that's what we want to address. I know all of you take your time out of a busy schedule to be with us today. So I promise you that I will make it everything within my power to make it well worth your time. All right. So who is this session designed for? It is for new investor, as the title suggests, right? For beginners, right? But of course, it's also retail investors. Some of you here show up who have maybe 5 years or 10 years experience. Literally, it's for anyone who want to learn about stock investing. Okay, today I'm going to share with you the safest, the proven safest, time-tested way how to make consistent return from the stock market without risking your hard-earned money. All right. So if you implement the strategy, which we're going to talk about later, which is value investing, you won't be fearful about the market. In fact, if the market comes down, you will celebrate, right? You will celebrate and, find for good bargain stocks, right? So even though the market is red, this time I took this opportunity to look in some stocks. All right. So allow me to briefly introduce myself. My name is Shane Chu. Some of you here could be new, may not have seen me before or seen me just one or twice. So my name is Shane. I started investing when I was in university. First year in university, I started investing. And the time when I started investing, it was during the subprime mortgage crisis. After then, I started to teach my university mates how to do investment. And when I was 23 years old, I was invited to BFM to talk about my life, talk about business. Subsequently, I was invited to many other media to talk about finance, personal money management, economy, company analysis, and so on. I also talk about entrepreneurship, right? So that was a little bit about myself. I was also featured on newspaper, magazines to give my feedback about the state of the market, and also to talk about the financial literacy among the investors. So professionally, what I do here is I'm a trainer who teach, who often got invited by and engaged by investment banks to teach retail investor about the market. So here are some of my work in the past. I worked with Kenanga, TS Securities, Bursa Malaysia, RHB, Alliance Bank, M Investment Bank, Hong Leong IB, and so on. Okay, so these are some of my physical workshop where I was invited to train their clients about investing. So the highlight of my life came when I got acknowledged by President Obama, who was the sitting president that time in 2015, as a young leader in financial education. So that was me meeting the world most powerful man, who is who is the American president, okay, back then. So if you're wondering whether this is from Wax Museum, from Madame Tussauds, it's not, okay, you see, you can move on, all right? So I was meeting the real United States president back then, okay? So if you want to connect with me, you can go to Facebook or Instagram to find Shin True 7. So that's how we can stay connected. On my Facebook page and Instagram, I talk on Facebook page, I talk a lot about the market, so we can stay connected, right? But if somebody by the name of Shin True add you as a friend, that's definitely not me. Okay, there are a lot of scammers who are impersonating my profile. Go out and ask you invest in crypto and so on. Okay, guarantee scheme. That's definitely not me. All right, so don't fall prey of these scammers who are impersonating me. All right, so that's a little bit about myself. The reason I talk about myself is not intent to boast, but just to let you know that I come from a background where I literally know nothing about investing, because my parents literally taught me nothing about investing. In fact, none of them invested in any asset before. And the only thing they teach me about money is that, don't invest. Investing is like gambling. So that's what they've been telling me. But unfortunately, or fortunately, okay, I pick up this hobby to learn to read annual reports, financial reports, okay, when I was in form 5. Then subsequently, I read a lot more investing books that began my journey in stock investing. Okay, now I've invested in the market for the past 15 years, and I've seen, the problem that older people have when it comes to investing in stocks is that, they rely on tips, right? So they always want to rely on tips to do investing. So why do they rely on tips? Because primarily, retail investor in particular lack the know-how or the methodologies to screen good companies and invest in good quality stocks. They don't know how to evaluate the values. So they want to make quick gain out of the this feeling of greed, right? So they want to make fast money and they want to make big money, right? So they lack the know-how, but they want to make big money. One of the ways is to know people who has insider tips, right? So every time people tell you, oh, got insider news, or these stocks is going to go up, right? Guarantee. So when the people invest in that, then that's how they lose money in the stock market. Okay, so think about that. Now, who are we? Are we retail investor? We are ordinary investor, right? We are the regular Joes in the market, right? Are we like business tycoons who have insider information? Or do we belong to the inner circle of business tycoon, business magnates who have this insider news to share with us? Most retail investors don't have access to this information. By the time we hear of insider news, right, it's probably that tens of thousands of people have already known it. So it is no longer insider news, but an outsider news, okay? By the time we hear it. Okay, so most of the time I don't really give a lot of consideration about all the insider news that I hear. Okay, if somebody tell me some insider news, I usually disregard them. Okay, so that's how ordinary people invest in stocks market, wanting to make it big, but eventually they lose it big because of ignorance. So on the other hand, there are people who really make it big in this game of stocks, right? So what are the common things that these 4 gentlemen have? I'm sure some of you here will say these are all Angmo, right? Caucasian, right? They are whites, okay? And some of you here may say that, they are wealthy, aren't they, right? And they're old, okay? Take a look at them. Okay, Warren Buffett is worth 110 billion. Okay, I think now it's worth 120 billion already. Christopher Brown, 260 million. Peter Lynch, 300 over million. Safe Klarman is 1.6 billion, right? So this is the known wealth, there are also a lot of private wealth that we don't know yet. Okay, so these are public available information that we can find, right? So all the private wealth is unknown yet. Okay, yeah. So like Lee Swan say, right? Their money is in millions, if not billions, right? So, but they still have one thing in common. Okay, they are all practitioner of this strategy called value investing. Okay, so with exception of Peter Lynch, right, who also subscribed to the growth investing concept. So they are all practitioner of investing strategies, which help them to make great fortune from the stock market. So if they can make it, so can we. Okay, we also want to crack the code on how to become a multi-millionaire, okay, if not billionaire, okay, through this investing strategy. Okay, so today's session, I'm going to talk about three secrets. The first secret I'm going to talk about is how do we compound money safely through investing. Then I'm going to talk about how do we reduce the risk of investing without having to monitor your portfolio day and night. And thirdly, we're going to talk about how to achieve 1 million with just a fraction of your income. Some of you here think that I can, meh? 1 million or other people can, maybe I cannot, right? So later I'm going to debunk the myth on how ordinary people can also achieve their million from investing. So let's begin. Okay. So there are a lot of asset classes in the world, right? So why stocks? Okay. Because among all these asset classes, right, the best performing asset class is actually equity. So equity deliver the highest return from the stock market. Okay. Highest return from the market. Of course, now recently we have a new, asset class, which is cryptocurrency. So taking cryptocurrency aside, if taking cryptocurrency aside, because they don't have so long track record, if you don't consider cryptocurrency, then equities is the best performing asset class across the history. Okay, take a look at S&P 500 from 1970 to 2020, right? For the past 50 years alone, S&P 500 deliver a compound annual growth rate of 7.65% return. So these are just capital gain. If we consider dividend, okay, on average, S&P 500 deliver about 9 to 10% return a year. So this is investing, just a buy and hold strategy, investing in strong companies. They are the 500 largest companies, listed company in America. Just buy and hold. For the past 50 years, your capital gain would be 7.65% a year and not yet consider the dividend yet. All right. So no asset class can deliver this performance very consistently over the years, and S&P and equities market is the one that can deliver this kind of phenomenal return across history. So if you take a look at the return on investment, even if you say that you are every time you say Shane, I'm very bad luck with the stock market. I have a lousy luck every time I invest, right? The next day it fall. Okay. So even if you have a lousy luck every single time, right? Let's say you bought at the peak during the .com bubble. If you bought at the peak during the .com bubble, then it come crashing down. If you hold it long enough until the end of 2020, your return on investment is 145%. That means you still double your money in 20 years period. Your compound annual growth rate is 4.6%. Okay. So in this case, you see, even though after you buy, the market comes down because you really damn sway, it comes to investing in stock, you really have lousy luck. If you hold it long enough, good companies will certainly appreciate in value. Okay. In second incident, second time, again, you bought at a peak during the subprime mortgage crisis in 2008. After that, it comes crashing down. But if you hold it long enough, okay, until the end of 2020, your return of investment is 137%. Compound annual growth rate is 6.9%. All right. So you see that, no, even though the moment you buy, it comes crashing down. If you have patience, so long that you know, invest in good companies, you invest in the strongest economy in the world, time will help you to compound your money. All right. So don't get overly emotional because the market comes down the next day or next month or the next 2 months. If you hold it long enough, you will still be in the green. All right. If we take a closer look at the recent 15 years, right, S&P 500 deliver about 409% gain for the past 15 years, and compound annual growth rate is 11.5% return, and that does not include dividend yield yet. Okay, had we included dividend yield, I think the compound annual growth rate would be about 13%. All right, so this is the phenomenal return that you can get from investing in stocks. Excuse me. All right, so this is a phenomenal return that you can invest in stock. So what's the secret here? Okay, the secret to compounding your return safely in the stock market and consistently in the stock market is what I think is value investing. Now, value investing is the proven, safest, and time-tested strategy that have delivered and helped a lot of people to create immense wealth. Okay, the safest strategy and can help you to get consistency. Okay, if you are somebody who love consistency, you want to learn how to stabilize your portfolio and deliver a consistent return, you must learn this strategy called value investing. So what's the definition of investment? Okay, so before we talk about investing, right, let's talk about investment first. Okay, so how many of you here know who this gentleman is? Now, if you know who this gentleman is, you may write his name in the chat box. Okay, if you know who this gentleman is, you may write his name in the chat box. So this gentleman is famous for three things. Okay, so the first thing he's famous for is being the teacher of Warren Buffett. He taught Warren Buffett how to invest in the stock market. He taught Warren Buffett value investing when Warren Buffett was studying in Columbia Business School. The second thing he's famous for is he's the founding father of value investing. He even coined the term value investing. The third thing he is famous for is he's famous for being the co-author of this book called Securities Analysis. He wrote the book Securities Analysis during the Great Depression to encourage people, to come back to the stock market. Because during the Great Depression in 1930s, okay, from 1929 to 1932, the stock market crashed 87% in 3 years' time. And a lot of people were fearful about the stock market, right? So people fled the stock market to go to the bond market. Okay, so he wrote the book Securities Analysis to tell people the stock market is dirt cheap after the subprime mortgage, after the Great Depression. The good quality companies are still selling at discount, right? So it's a time for you to return to the stock market, and buy into the stocks instead of bond, right? So his name is he's none other than Mr. Benjamin Graham. So Hafiz Othman, thank you so much. You're right, okay? His name is Benjamin Graham. And in his book, right, Securities Analysis, I have gotten a book before. I have read the book. And when I read the book, right, in one of the chapter, that's how he defines investment. So I pick it from that chapter, okay? He said that an investment operation is one which, upon thorough analysis, promises a safety of principal and an adequate return. Operations not meeting these requirements are speculative. So this is how he defines investment. So there are three keywords here. Excuse me. The first keyword is thorough analysis. Okay. So in other words, when you want to do investment, not only are you expected to do an analysis, but you are required, okay, to do it thoroughly, comprehensively. You must know inside out about the asset that you want to invest in. So this is the first keyword. The second keyword is safety of principle. So when we invest our hard-earned money, we must at least be assured that our principal is safe there. Okay. At a minimum, you must know that you park your money with a licensed person or licensed broker, licensed agent, right? But not some, random person who have no license, who appear a bit more fishy. So at least you know that the principal is safe and you know what the money is going to be used for. Okay. The third keyword here is adequate return. Because we are not doing charity, we are not doing philanthropic work. So when we invest our hard-earned money, we must expect some yields, okay? And we must expect it to be adequate, right? To justify the risk that we're going to engage in. So these are the three keywords: thorough analysis, safety of principle, and an adequate return. Any one of these three keywords missing, you're not investing. You're speculating, you're gambling in the stock market. Okay, so that's how he defined investment. So I want us to reflect, okay, when we do investment, right? Do we do it thoroughly? Okay, do we always assure that it is there's a safety of principle, and do we do we really want to get an adequate return? So these are the three keywords here. All right, so that's how he defined investment. So after we learn about the definition of investment, so how about value investing, right? What is this strategy about? So value investing, I'm sure that this is not unknown to you. You have heard of many people who have told you this before. So value investing is essentially a strategy that teaches us how to buy good quality stocks at discounted price. So the reason they can be the safest strategy ever known in investing is that the drive to focus on the quality of stocks, and we only want to buy good quality stocks with decent growth prospect and buy it when they are cheap. So if you buy good quality companies and when they are cheap, right, there is not excessive risk that we are taking. Okay, and there's still some risk there, but it is not huge risk that we're undertaking. All right. So essentially, it's a skill that allows us to buy 1 ringgit worth of stock for 50 cents. So this is what the strategy is about. In the diagram format, we always want to find a stock whose value keep increasing, but the share price keep decreasing. So when we find a stock whose value is going up, but the share price keep coming down, when there's this value and price divergence, that's when we go into this stock. All right. So this is value investing. So I'm sure you'll be asking me, Shane, is it possible that when value of the stock goes up, price comes down, right? The answer here is it is not common that we see this kind of situation. It happens when the market is emotional. Every time when the market is emotional, there's this value and price divergence. All right. So when this happens, value investor will take advantage of this situation and scoop up good quality stocks at discounted price. So when the market is red color, then maybe there are some bargain somewhere. So we must take out our magnifying glass to go to see where the bargains are at. All right. So in the economy good time, this kind of bargain may not surface so easily, right? But in a bear market, when economy is in recession, right, or when the market is bad because there's financial crisis somewhere, okay, and it caused the market to tank because the sentiment in investing is very bad, then among 10 counters that you search, right, or you research, right, maybe 7 or 8 stocks are selling at discount. So this kind of value and price divergence would be more prevalent during times of fear. All right. So is it a skill that easy to learn? Absolutely, right. It is a skills that we all have learned, right? So it's exactly the same skills that when we go to that we use when we go to shopping mall, right? If you go to shopping mall, if you really love this pair of shoes, right? Yesterday they were selling for 500 ringgit. Today, the same pair of shoes are selling for 250 ringgit and really love them. So would you buy it? Most likely, yes, right? You will buy them, right? Today. Because yesterday they were selling at 500 ringgit. Today, they are selling for 250. So you buy them because they are bargain. So would you go to the shopping mall and say that, this pair of shoe today is 500 ringgit. Yesterday, they are 200 ringgit. Today, 500 ringgit. You buy, very unlikely, right? You won't buy when the price goes up, right? You want to wait for bargain, correct or not? So essentially, we want to take the same skills and go back to the stock market, okay, and apply it in the stock market. When you see a stock, right, yesterday, 2 ringgit, today, 3 ringgit, would you buy or not? Most investor will buy lah, because go up ma, okay? But as value investor, we need to be a contrarian. So we want to see, is it still undervalued or not? If undervalued, maybe we can consider. But chances are, most of the time in a strong bull market, it could be because it is not so easy to be undervalued. Okay, so high chance that to be slightly overvalued lah. All right. So on for value investor, we are all contrarian. We want to buy when the stock price comes down, right? So we want to take the same strategy we use in shopping mall. If the price from yesterday 2 ringgit today 1 ringgit 50 cent, that's when we examine does the value surface, okay? Does the value emerge? So if there's value in this, then we may buy. All right. So that's value investing. Okay. So during a inflationary period, bull market, okay, maybe out of 10 stock you study, 20 stock you study, and maybe one stock is selling at bargain price. During during financial crisis, out of 10 stocks you study, maybe 7 or 8 stocks are selling at discount. So this is a critical period where we're able to find a lot of opportunity in the market. So next time when the market comes down, we should celebrate, right? Because there are more chances for us to find good stocks that are selling at discount. So essentially, what value investing teaches us is how to find undervalued stocks. Okay, it's not about finding cheap stocks, because cheap and undervalued, there's a big distinction between being cheap and being undervalued. Cheap stocks may not mean that they're undervalued. Cheap stock are there because they could become cheaper. Okay, so they are cheap because for a reason. Okay, but undervalued stock would be cheap in comparison to the value. Okay, so cheap stock doesn't mean that they're undervalued, but undervalued stock are definitely cheap in comparison to the value. So in value investing, our focus is not to find cheap stocks. Our focus is to find undervalued stocks. So what are the characteristics of value investor? Value investor, number one, they select stocks based on value. They don't select stock based on price. Not like this stock 50 cent cheap, I buy. This stock 150 ringgit, expensive, I don't buy. No, okay. Value investor evaluate stock based on the value, not the price. Secondly, we search for companies whose price is below their value. We always want to find, after we determine the value of the company, we see that, the price is actually lower than the value. That's when we like this kind of company. Third is we focus on the company and its business. So there are two markets here. The first market is the real market. The second market is the stock market. Okay. So if you're an investor, if you're a value investor, we focus on the first market, which is the real market. Okay. Traders focus on the stock market. So if you want to invest in Starbucks, then you want to observe Starbucks reporting better revenue and earnings this quarter. Do they have more people patronize their outlet? Or the boycott really affected them? Okay, so you want to study the real market, okay, real business. On the contrary, if you are a Starbucks trader, if you are traders, you want to trade Starbucks stock, then you focus on the stock market. You look at the volatility of the share price. You look at whether there's momentum or not. Is the momentum, is this a bullish force or is it a bearish force, right? So you want to identify the sentiment in the market by looking at the share charts, right? So this is what traders focus on. As a value investor, we focus on the real market. We focus on buying great businesses, but not trading the stock price. So what you need as a value investor is very simple. Do you need an accounting degree? No, you only need to have simple mathematics literacy. Okay, so you need to learn how to do plus, minus, multiply, and divide. If you know how to do plus, minus, multiply, and divide, then you fulfill the first criteria to be a value investor. Secondly, you need to have common sense, right? Do you have common sense? I'm sure most of you here have common sense, right? So you have common sense, then you fulfill your second criteria. Okay. Third, you need to have basic fundamental analysis knowledge. You need to know how to read basic financial statements. Okay, you need to know what does this ratio mean. Okay, So this is basic fundamental analysis knowledge. And last but not least, you need to have time and patience. Okay, after you buy the stock, you need to let time to compound your money. You don't want to, after you buy the stock, you expect tomorrow the share price goes up, right? That is not so likely. Okay, you need to have patience. A lot of time when value investor buy the share, the next day the share price still come down. Because why? Because value investors are typically a contrarian. We buy when the share price is on a downturn. Okay, and then we have a strategy on how do we enter the market. Okay, so when it's coming down, chances are the next day it might still go down. If we go down further, then we buy more. Okay, so that's why we need to have patience, because value investors believe that in the long run, the true value of the company will be reflected in the stock price. Okay, in the short run, the market is like a voting machine. They vote whether there are more buyers or more sellers. But in the long run, it is like a weighing machine. Only good quality companies with real weight will stand out among the rest. So this is why we need to have time and patience and wait for the value of the stocks to be, true value of the stock to be reflected in the share price. Do we need to learn complicated charting? The answer is no. We don't need to learn charting. Okay, so let's take a few examples of some of my case studies, which when I first started out, this is one of the companies that I study. Okay, so back then I started with some companies that I really know, because I was still a newbie, a rookie in the stock market, right? So Tenaga is one of the first few companies that I studied back then. Okay, in 2007 to 2008, right? The market came down. Okay, so Tenaga came down to about 3 ringgit 85 cents. Back then I remember that when I did the study, the NTA of Tenaga was at about 6 over ringgit. So what exactly is net tangible asset per share? Okay, so net tangible asset per share means that if during that time Tenaga decided that, I am very tired of my business, I don't want to keep doing this business anymore, I want to close shop already. Okay, so they sell off all their tangible assets, pay back all the liabilities, and every shareholder can take back 6 over ringgit. Okay, so that's what net tangible asset per share mean. Okay, so the NTA per share at that time was about 6 over ringgit, and the share price is much lower than 6 ringgit. Okay, in December 2008, right, it was trading at 3 ringgit 85 cents. Okay, so if you had bought during that time, even it's hold it until June 2018, 14 ringgit 40 cents, right? So your capital gain would be 274%, compound annual growth will be 14.9%. You have received 13 times dividend and giving you dividend yield of 59%. So your total compound annual growth rate, including dividend, is 16.68%. This is just buy and hold strategies for 10 years. You bought in late 2008, hold it until June 2018, about 10 years period. Every year, buy and hold, you earn about 16.68%. Okay, so this is the return that you can get from buying into a blue chip stocks when they are undervalued. Okay, did Tenaga have anything to do with the US subprime mortgage crisis? No, right? Because they are utility player in Malaysia, and they have some regional asset here and there. Are they exposed to financial instruments in the US? Are they exposed to the mortgage-backed securities in the US? No, right? They are also not a developer, right? So in the US, they don't build houses, right? But the subprime mortgage crisis also affected their share price. Why? Because the sentiment was bad. Investment banks were closed, right? Or went bust. So people were fearful. When people were fearful, they did irrational decisions. So they sell off stocks, including stocks that got nothing to do with them. They sell stocks that are good fundamental. And if you can manage to take this opportunity, you buy into a blue chip stock, your return will be about 16.7% in the next 10 years. Okay, so this is one of the value stock that I learned when I first started out. Okay, so let alone all the bonus issue that you could have received if you have stayed invested. So some of you here may say, 16 over percent return a year might look a bit small to me. Okay, because I don't really like blue chip. a lot of retail investor in Malaysia like small cap, right? Small cap, of course, come with higher risk lah. Okay, so of course, there are also great small cap counters who eventually become mid cap to a blue chip, right? So so this is another stock that I bought back then. The name is Magni. Okay, so what does this company do? This company is the manufacturer of apparel. Okay, so one of their key customer is Nike lah. Huh? So they did a lot of they did a lot of shirt for Nike. So if you have, I've bought into this stock in June 2013, and that was only 34 cents. Of course, this is an adjusted share price after all the corporate exercises. The real price I bought was higher than that, but post the what do you call that? After adjusted for corporate exercise, this was the adjusted price. Okay. So before I bought it, right, the business was doing at about double-digit growth in terms of profit and in terms of revenue. Current asset and current liabilities were the working capital is healthy, and the dividend yield was pretty attractive as well. Okay, so I bought into this stock knowing that this stock is undervalued because the PE ratio was only 6, and sell it in May 2021, and giving me about let me count. So 570% capital gain, compound annual growth rate is 26.9%. Okay. Total dividend you receive is 22 times. Dividend yield alone is 379%, and total dividend including total compound annual growth rate including dividend is 32.5% return. So this is how investing in a small cap counter, this is the return that it can deliver to you, because the business is growing at double digit at the bottom line and also the top line, but then the PE ratio, the valuation is pretty attractive at single digit at about 6 times. So that's when I bought it. All right. So this is how I perceive as value investing in the local market. Another company that I bought was RC Cap. Okay, I bought it in November 2019, and I sold it in October. Okay, 2 years later. So the moment when I bought it, right, the share price was 1 ringgit 63 cent. The dividend yield was fetching at about 6%. The price to earnings ratio was 6 times. Okay, 6 times PE ratio. This company consistently deliver growth, year-on-year growth in their quarterly reports. Every single quarter, they deliver profit growth. So if you don't know what RC Cap does, they are involved in the money lending business. Okay, they primarily lend money to civil servant. Okay, so when I bought into that, I'm thinking that this stock is growing modestly. Okay, not super high growth, but growing modestly. They are very consistent in growing their profit, and the PE was only 6 times. Okay, so the dividend yield is attractive, sometimes more attractive than some banks, right? So I decided to buy into this stock. Okay, so the capital gain was 101% over a period of 2 years, giving me a compound annual growth rate of 41.9%. Total dividend I received was only 3 times. Dividend yield is 11%. So the total compound annual growth rate, including dividend, was 45.9% return. Okay, so this is how investing in small cap can deliver the return to you. All right, so if you buy into a good stock, buy when they were cheap. That's how you can make a better return and consistent return in the stock market. So I've given you 3 case studies of how I do value investing, how I buy a good quality companies growing at double digit, how I buy when they were still cheap, and buy when their dividend yield is also pretty attractive, right? And I hold it for sometimes, and that's the return that I receive. Okay, so this is some examples on how value investing can apply in the local market. Secret number 2, what we're going to talk about is how do we reduce the risk of investing without having to monitor your portfolio day and night. Okay, if you bought into stocks that can really, jump off the cliff, like what happened in these few days, right? Then some of us here would have a sleepless night lah. Okay, some stock that we bought is of poor fundamental, then we may need to monitor the share price day in and day out, right? So how do we reduce the risk of investing? Okay, the secret here is to buy good fundamental company. Okay, and not only just buy good fundamental company, but the trick here is to buy it with high predictability. So this is risk management. Okay, in investing, right? You know, one of the safest risk management strategy is don't buy loss making company, don't buy company with no consistency, no predictability. Buy solid, good fundamental company and with high predictability. So this is how we can avoid jumping into stocks that can crash, limit down for several days, right? So if you buy good quality companies, this is what we can avoid, right? You see, some of the counters here were worth billions of dollars, billions of ringgit market cap. And in just a few days, they're down to 100 to 200 million market cap, right? Which this is a very crazy speed, okay? When it crashed, right? From billions to hundreds of millions. So in just a couple of days, right? So if we just focus on good quality companies, this can be avoided. All right. So you see, even the mice who want to take the cheese will also wear a hat, right? This is risk management. So is there a risk in anything we do? The answer is yes, right? There are risks everywhere. Even though when we cross the road, there are also risks, right? But can we say that because of risk, we don't want to invest? No, right? So we just need to learn how do we protect ourselves. It's like, is there a risk in driving? Yes, right? So can you afford not to drive? We can't, right? Because we need to commute. We need to get around town, right? So we need to get from one place to another. So how do we protect ourselves? We fasten our seatbelt, make sure that we drive and we are still in good condition, mental in good condition, not like drunk or tipsy, right? So we make sure that our indicators are working. Okay, so these are the risk management that we do. Similarly, for investing, we must also have our risk management. And the number one way to avoid all these kind of stocks, right, that jump off the cliff, is to avoid lousy companies. Okay, so some people, right, because of all this volatility in the market, right, they prefer to do property investment because they like it because it has steady appreciation. It is safe. It give them rental income, and they can flip right where the price is good. But in stock investing, right, they look at the volatility. Oh, sometimes go up, sometimes come down, right? Very dangerous. It's very volatile. I cannot take it. Highly speculative. Okay. So these are some reasons that investors don't like stocks. But let's take a look at the criteria in stock investing. Okay. Let's look at criteria of property investing. How property investor invest in properties, right? So of course, I'm sure you heard that, good location. A lot of property investors, when they buy property, they must buy at a good location. Okay. So this is very important. Number two, high occupancy rate. They want to buy properties with high occupancy rate because higher occupancy rate means that it's easier for them to rent out, right? To lease out to tenants. High rental yield, right? High rental yield means that, they could have positive cash flow. Okay. And last but not least, below market value. When they buy below market value, chances are they can fetch a better yield, right? So this is the basic criteria property investors have, okay, when it comes to investing in property, right? So can we learn from property investors in this scenario? The answer is yes, right? We can also learn from property investors. So if we learn from property investors, maybe we can make our investment safer, right? So what is good location? Good location could be equivalent to investing in stocks that is in the right industry and they have the right business model. All right. They're in the good industry with good business model. High occupancy rate could mean that they have high sales, right? They are not worried that they have no customer, right? They always good sales. Okay. High rental yield would mean that high dividend yield. Okay. Every time they have high dividend yield, they declare high dividend yield to you. And we buy below the market value would mean that we buy below its intrinsic value in stock investing, right? So you see, we can actually model the strategy to invest in properties and duplicate it in stock investing. Okay. So when we do that, we can turn property we can turn stock investment to have steady appreciation, to be really safe, and give us dividend income, and also give us capital gain, right? So that's how we model property investment and get a similar return, right? Stock investing is only risky if you do it riskily, okay? You engage in excessive risk taking. You buy, stocks that are volatile. You buy stocks that are poor fundamental because you receive some news that this small cap counter will go up. That's how people lose money in the stock market. Okay, they don't invest in stock. They goring stocks. Okay, so that's what we want to avoid. In value investing, we want to get steady appreciation and want to make sure that our capital is safe there. So what can we learn from Warren Buffett? So let me share with you. Warren Buffett focuses on these 4 things when he invests in businesses. Okay, number 1, he wants to invest in simple businesses that he understands. He doesn't invest in business that he doesn't understand. Okay, even though it means that he lose out to some trends that could become big, right? Sometimes he is a latecomer to some business or to some industry, right? But it's so long that he does not understand it, or if the business is too complicated, he wants to avoid it. Okay, so he will only invest in simple businesses that he understands. Number 2, he wants to invest in business that have predictable and proven earnings. Because when the companies have predictability, it is more certain that we can determine the value of the stocks. If the company has a very erratic business result, some years up, some years down, some years was loss making, that business is not easy to really value. So his strategies is to only invest in business that have predictable and proven earnings. Third, which is very important, is he only invests in business that has wide economic moat. He does not invest in business that have very weak or literally none competitive edge, and they're not sustainable. Okay, so they want to find a business that have strong competitive advantage, they have wide economic moat, that can protect this business from the competitors. Okay, and when a company has wide economic moat, that's when they can grow in a more sustained manner into the future.